My name is Ben Leybovich. I bring this video to you as part of my financial literacy and real estate investment blog, JustAskBenWhy.com, where we teach you to plan for and to take action to achieve financial freedom. My mission? To help you understand how to use real estate to achieve your financial goals. This video is a continuation to a video entitled Financial Statement. In this video, I'd like to discuss more of the application and the perspective on the financial statement that'll help us get ahead. Okay? That application, that perspective is this. There's a relationship between the balance sheet and the income and loss statement, which gets missed a lot. There's a definite relationship. Okay? Let's talk about what is an asset. Traditionally defined, if you ask your CPA, an asset is something of value that you can own. Okay? It's an asset. Okay. That asset would go into the asset column. Right here in the balance sheet would go into the asset column. If you have a loan associated with that asset, it'll go into the liabilities column. Okay? Here's the trick. Anything that's in the liabilities column is going to result in an expense. Not necessarily, you would think that, just the exact opposite. Anything that's in the asset column will add to the income, but that's the problem. Not necessarily so. Let me discuss assets. There are three types of assets as far as I'm concerned. There are positive cash flow assets, there are negative cash flow assets, and there are neutral cash flow assets. Simply defined, positive cash flow assets make more money on your behalf than they cost to own. Okay? Very simply. Positive cash flow assets make more money on the monthly basis than they cost. Negative cash flow assets cost more money than they bring in. That could also be because they don't bring in any money at all. And neutral cash flow assets have value, intrinsic value. However, the devil's in the details, how you define the value. And even though they don't cost you anything once you purchase them, they also don't make anything. Okay? Now, here's the trick. I put value on things based on the amount of income that they generate. To me, financial freedom is the ability to position myself in such a way so that I generate my income by means other than having to have a job and trade services for payment. Okay? Because why? Because what if I get sick? If I rely on having to work to generate income to pay my bills that show up on a monthly basis, if I am unable to work, I am in big trouble. There are only two ways to cope with this. Buy an insurance policy, which most people do. I buy assets that generate income. Okay? Let's talk about this. Let's take several assets for example purposes, and let's see their application to the financial statement. A car, a 401k, a painting, investment real estate. Okay? Let's talk about a car. You bought a car, you went out, it cost, $25,000 2 years ago. You put, $3,000 down, and you still, you started out with a loan of $22,000. You've been making a payment on it. It's been 2 years. So today, the car is worth $18,000 because, it loses value over time, right? It's one of those assets that lose value over time. However, they have value. The car has value. So if you talk to your CPA, the CPA would put the car into the asset column of your balance sheet because it has value and because you own it. That's the definition of an asset. The CPA would also put the loan, the remaining balance on that loan, into the liabilities column. The balance of that loan As long as it's there, you signed up for 5-year, let's say a 5-year payment, that starting balance was $22,000 after you put $3,000 down for this car. It doesn't matter that you only have $15,000 left on the loan. The payment stays the same. So whatever that payment is, for 5 years, it shows up into the expense column. Now, you just bought an asset which has value, so it fits the traditional definition of an asset. But how is it really impacting your financial position? It's showing up in the expense section. If you make money by working a job, you just created more necessity to work that job, not less. So purchasing that specific asset puts you further away from the attainment of the goal of financial freedom. Let's consider a 401k. You have a 401k. Let's say your employer offers a 401k. Obviously, you own it, and obviously it has value, or at least I hope it has value. But it fits the traditional definition of what is an asset. Your banker, your CPA would put it into this asset column, okay? Now, you don't necessarily have any loans associated with that in the liabilities, but what happens with a 401k? You get your income paycheck every week or every 2 weeks or every month, whatever, and then you take a portion of it and you throw it at that 401k. So is it not costing you money? I mean, you're taking a portion of your income and you're choosing to put it here. So the only way that this is impacting, that ownership of this asset is impacting your day-to-day, month-to-month cash flow position is negatively, because you're taking money to put into that 401k. Now, if your employer matches it, then obviously you have kind of a built-in rate of return on your investment. Okay? And obviously over time it may go up in value. It may lose value. You don't know that. It's kind of a cat in the bag type of thing, right? And but on a month-to-month basis, I hope you guys can see how we're trying to position ourselves so that the expense column is as shrunk as possible. Because we're trying to get out of having to have a job. Okay? So, 401k, maybe it works, maybe it doesn't. Depends on who you talk to. A lot of people I talk to, maybe not so much. Let's consider a piece of artwork. Okay, so traditionally, a good piece of artwork appreciates over time in value. So once you buy it, you put it in here. You don't really have ongoing liabilities. I don't think you can finance a piece of artwork, so you're not going to have a loan associated with it, and you're not going to have ongoing payments. So in lieu of holding money in a bank account, if you want to buy a piece of artwork because you enjoy it and you want to put it on the wall, and you've done your research and maybe chances are pretty good it'll go up in value because, you know, the artist is no longer around and that's just how it works. If that's what you want to do, great, that's okay. But does it create income for you? Because if you're like me, a 36-year-old guy who wants to be retired by 45 and wants to make sure that regardless of what happens to me, my family is fine, they don't need a piece of artwork on the wall that they have to worry about selling and all that. They need income. I need income. That brings me to that Fourplex that I discussed in another video that throws off $700 of income, or of cash flow a month. $2,400 of income. So you put the Fourplex into the asset column. The $2,400 of income show up right here. The $1,700 of expense show up right here. One of those expenses is a mortgage associated with the ownership of this Fourplex. That's the liability. Okay? But all of my payments combined, including taxes, insurance, the payment on this mortgage, whatever, upkeep, if this number is less than this number, then do you see how the net positive result is the $700 of cash flow right here that didn't come from my job? It came from an asset that I purchased. So the question is, how many of those assets just like that do I need to purchase before this cash flow pays for my life? in terms of my bills come in on a monthly basis. I want this passive cash flow generated via my assets to pay for it. And then I can be retired. And I can be secure that my family is on sure footing, financially speaking. This relationship between income and loss statement and the balance sheet, this is what gets missed. In 1906, an Italian economist named Vilfredo Pareto discovered that in his garden, 80% of the peas came from 20% of the pea pods. This led him to do some research and later conclude that 80% of the money belonged to 20% of the people. 80% of real estate belonged to 20% of the people. 80% of knowledge belonged to 20% of the people. I may be in the minority in the way that I look at what is an asset, which is something that generates more income than what it costs. Vast majority of people are involved in investments which do not produce income. Vast majority of people don't retire by the age of 45. The choice is ours. My name is Ben Leybovich. This video is brought to you as part of my financial literacy and real estate investment blog, JustAskBenWhy.com. Please visit me at my website at www.JustAskBenWhy.com. You can also link up with me on Twitter, YouTube, and Facebook at /JustAskBen. Thank you for listening. I appreciate your time. I hope this was educational. And I will speak to you next time. Bye-bye.